Nobody ever gets rich when the interest rates are high because people can't borrow money.
Is that what you meant? The stock market going down was the disruption? What other disruption were you alluding to?
Look, you can't really watch the stock market. You have to do what's right.
Hi guys, welcome to Cashcraft Finance. So I don't usually do this, but 2 weeks ago I issued a warning to stock market investors. And unfortunately, since that video, things have gotten a lot worse. Just today, the market has seen its worst drop since 2022. Panic usually creates more panic. Selling pressure creates more selling pressure. And prices are falling purely because prices are falling. So similar to my previous video, I'd like to help put into perspective exactly what's happening, why the market is crashing, how things could get worse before they get better, and what you could do about it to put yourself ahead financially. Yes, I'm probably going to have to repeat myself a few times, but at least you should understand the truth about what's actually going on. As soon as you hit the like button and subscribe if you haven't done that already, that's all I ask for. It helps the channel tremendously, and as a thank you for doing that, I will do my best to read and reply to as many comments as I can, so thanks so much. And also a big thank you to Incogni for sponsoring this video, but more on that later. Alright, now in terms of why the market's crashing, as of now we have the perfect storm, starting with tariffs. Now here's the thing when it comes to talking about tariffs. So far, here's how they've worked. Trump threatens tariffs by a certain date. The market goes down but eventually starts to recover. On the day tariffs go into effect, the market plunges because no one expected it to actually go through. But 24 to 48 hours later, an agreement is reached that gives an extension. The market goes back up, and then the process repeats itself when tariffs go back into effect, waiting for another agreement to be reached. This volatility starts to give the impression that tariffs have simply been used as a negotiation tool to get more favorable trade deals within the United States. But the market never actually priced in the likelihood of them sticking around, until this. It's currently scheduled that a 25% tariff on steel and aluminum imports are set to take effect March 12, while a 250% tariff on Canadian dairy products could be next, along with a tremendously high tariff on Canadian lumber shortly after. On top of that, what's really fueling the tariffs is that he said tariffs may still go up as time goes by. Now, even though that 250% dairy tariff has largely been debunked as an item that's not even going to begin going into effect, since they will be allowed a certain amount of dairy to enter the United States tariff-free, business owners are completely puzzled by what to expect, if they need to order inventory ahead of time, or if they have to start raising prices to cover overhead, to which Trump provided no additional information. To make matters worse, Canada retaliated by enacting 25% tariffs on electricity imports to New York, Minnesota, and Michigan, starting right now. And China slapped back with 15% tariffs on American farm products. As a result of this, investors are beginning to price in the likelihood of higher prices, lower GDP, recessionary fears, and the potential that things could soon get much worse. But there's a second reason the market could be falling that most people have no idea about. And that would be Trump crashing the market on purpose. First of all, it's important to clarify that this is just a theory. But you know what? Nothing surprises me. So here's what we know to be fact. Right now, it's no surprise the government owes a lot of money. The national debt is currently sitting at over $36 trillion, and that number is only expected to keep going high, which is soon going to cause a lot of problems. Why? Well, when you have a debt this large, you have to pay interest on the debt. And when interest rates are at record lows, paying off the debt is very easy. Like, imagine it to be like a mortgage. Taking out $1 million loan at 0.5% interest is as simple as spending $5,000 a year to keep current on your monthly payments. But what happens when interest rates go up during a time that you're borrowing a lot more money, and you've only locked in that record low interest rate for a few years? Exactly. Since interest rates have gone up significantly, the United States is now spending more money on interest payments than they are on defense for the first time ever in history, which is massive. And in 2025, there's another $9.2 trillion worth of debt that needs to be refinanced. This means they either need to lock in rates when everything is high, or they need to create a market crash, which causes interest rates to fall and gives them enough time to lock in interest rates for the next few years. Again, even though a lot of this is just a theory, some of it does make a lot of sense because 70% of the $9.2 trillion debt needs to be refinanced by June 2025. And if nothing is done, that debt is scheduled to cost 1% more, which is reported to be $1.56 worth of cost for every dollar of revenue that the United States generates. Think about it. For Trump, this could be a huge win to refinance the national debt at a lower interest rate than usual by forcing the Federal Reserve to lower interest rates. Like here are some quotes that I pulled from Anthony Pompliano, who's taken the time to compile some choice words by Donald Trump. Here you go.
I've been saying, let's get interest rates down. Nobody ever gets rich when the interest rates are high because people can't borrow money. Interest rates are going down. You know what else is going down? Energy's going down. I'd love to see energy go down.
Is that what you meant? The stock market going down was the disruption? What other
be a little
disruption were you alluding to?
Look, what I have to do is build a strong country. You can't really watch the stock market. If you look at China, they have a 100-year perspective. We have a quarter. We go by quarters.
That's true.
You can't go by that. You have to do what's right.
All of this paints the picture that maybe this is his way of reducing the cost of the national debt. Perhaps he could frame it in such a way that he's making asset prices like stocks, real estates, and Bitcoin more affordable to middle-class Americans by giving them a 10 to 30% discount. And if short-term pain is what's needed, then he's willing to get there by any means necessary. Although, in terms of how bad things could potentially get, in terms of how bad things could potentially get, you're going to want to hear this. On a broad scale, there are 3 different types of declines that you're going to want to be made aware of. The first is what's known as a stock market correction. That's defined as a drop of at least 10%. Now it's important to recognize that normal volatility throughout the market is extremely common. Like since 1920, the S&P 500 has on average seen a 5% pullback 3 times a year. So random fluctuations happen all the time. This is also somewhat the case with market corrections, which have happened on average every 16 months. In fact, if you're like me and you like averages, so far the average stock market correction has been 15.6% and lasts for 71.6 days. So it's perfectly normal, and every healthy market sees a regular pullback from time to time. However, after that we move on to the more serious category, and that would be a bear market, which is defined of at least a 20% drop from the peak. And this is where the NASDAQ might soon be approaching. According to the data, this typically hits every 7 to 10 years. And when it hits, unfortunately, it hits kind of hard. During a bear market, the stock market drops on average 33.2%, and it falls over a period of 363 days. Now, it is important to clarify that these are just averages, and it doesn't mean the next bear market's going to fall exactly 33% and last for exactly a year. For example, in 2020, we saw the fastest 30% drop in history since the Great Depression. And then right after that, we saw the quickest recession in history, which lasted just 33 days. So anything can happen. Although, in terms of taking it even further from here, things can always get a lot worse. And that's what brings us to a stock market collapse. I would consider this to be a drop of at least 40% throughout the entire market, and not just in one sector like cryptocurrency. And over the last 120 years, this has only ever happened 3 times. This is why a market collapse is rather uncommon, but it's not impossible to happen throughout our lifetimes, which is something that everyone needs to keep in mind. But in terms of what you could do to use this as an opportunity to come out ahead profitable, here's my take on things. First, when it comes to building wealth, it's important to recognize that there's always going to be a reason not to invest. Like when I started buying real estate in 2011, the overall market had already fallen 50%, and I was buying some of these properties for 20 cents on the dollar. But I was told to wait because shadow inventory was about to be unleashed on the market, and prices were about to fall even further. But guess what? That shadow inventory never came. The market recovered, and I'm so glad I didn't listen to all the people who told me not to buy. Even in early 2017, when I started making videos here on YouTube, there were so many headlines about how the market could be poised for a crash or how the market was overvalued, but I just kept dollar cost averaging on a regular basis, and I'm glad I did. The same thing applies to 2020, 2022, and I'm sure even today. Second, investing is not a game. I hate to say it, but when you really get down to it, investing shouldn't be fun. It should be pretty boring. I know that sounds weird to say because for me, investing is a total blast and I love it. But it's not a sign of a healthy market when people are trying to YOLO their life savings into whatever is the hottest stock of the day to try to get a brand new Cybertruck. At a certain point, you have to remember, if you're trying to beat the market average, you're either taking a calculated risk or you're gambling. And the line between the two has gotten incredibly blurred over these last few years. Third, overconfidence is going to destroy your portfolio. The moment that you think you have the entire market all figured out, you've lost. Because of that, it's really important to recognize that the less you know, the better you will do, because you're not going to overcomplicate things and take unnecessary risk for gains you never needed in the first place. For example, every single study shows that the best investors of all time simply buy into an index fund on a regular basis and hold it for 20 years. This is why dead people often make the best investors, because they don't touch it. They just buy and they hold. And that is what chances are you probably need to do as well. Fourth, let's face it. A market drop is probably going to be a lot worse than you expect. Like, when you see a decline, so you buy in, and then it drops even further, so you buy in even more, and then it keeps falling until eventually you run out of money and it keeps falling even more. Well, generally, market bottom takes place at absolute investor capitulation, where people think the economy is forever finished. No one is buying in, and people think to themselves that it'll just continue getting even worse. This was the case back in the worst of 2020, 2010, and I'm sure back in 2001, even though I was too young to remember that one. Every generation, I promise, is going to have their own moment when they think to themselves that this time is different. And even though it's always recovered in the past, this time, today, has never been like anything before, and we're probably all finished. That's why I tend to think that it's reasonable to expect that things can always get a lot worse than you expect them to. And just to be prepared for that. Fifth, good financial habits should be practiced in both good and bad markets. Even though now is certainly a great time to work some extra hours, take on a side hustle, cut back on unnecessary spending, and invest the difference, ideally you should be doing that regardless of where the stock market trades. Yes, I understand it's not cool to live frugally and live below your means when everyone else is making 10 times returns on meme coins, but I promise you, if you just stick with it long term, it's going to pay off 10 times more in the future. I guess I've just seen so many careers come and go, so many businesses go bankrupt out of nowhere, and so many investments lose value that I just tend to be overly cautious about what I do. Plus 6, it was found that in the event we hit a bear market, half of the S&P 500's strongest days in the last 20 years occurred during a bear market, and another 34% of the market's best days took place in the first 2 months of a bull market, before it was clear that a bull market had even begun. This is really important to mention because if you just miss the best days of the overall market, your returns drop substantially, and if you stay out of the market, it's even possible to begin losing money. This is why, regardless of what happens to the stock market or how bad the sell-off gets, there's always a reason to say, this time is different. Sure, the market might continue selling off much more than we initially expected, or it could rebound the next day. I have no idea. That's why, as long as I'm not planning to use this money over the next 20 to 30 years, any short-term fluctuations make no difference whatsoever. It's just an opportunity to buy in a little cheaper. And if you appreciate this message and me trying to get this video out as soon as possible, please hit the like, bell dings button, and subscribe if you haven't done that already. Again, that's all I ask for in return, and I'll do my best to read and reply to as many comments as I can. So, thanks so much.